You're listening to REIA Radio, the nationally trusted name in real estate investing. We dig deep to discover investors' why in real estate. If you want to skip all the BS and get in investors' heads, you're in the right spot. Be one of the thousands to check out REIARadio.com. Welcome to REIA Radio, episode 245. This is the Real Estate Rundown with Chris Pomerleau,
Ted Kosh,
Owen Dash.
Yeah, we got to work out the kinks on these three-way intros, but I think we'll get there. Welcome to the studio, Chris. Chris Pomerleau, part 2. You were in our former studio, the ramshackle place of our origin story.
Episode like 20 or something like that. I'd have to look.
That was way back in the archives.
3 hours.
Yeah, we couldn't even find video footage of it. So that's how far back it was. It might be on VHS somewhere. Ted's collection.
We have a few hard drives that are still sitting around
somewhere. It's like the Indiana Jones, the Ark in the warehouse.
He's laughing because I used to do photograph for Omaha Nightlife and have these spindles of CDs from the photos I took for the first few years. And that's my hard drive.
There is some alarming footage in there, I will say. I didn't know what I was expecting, but it was not that. Let's just leave it at that. So Ted's got ample ammunition for some blackmail activities if he ever chooses to go dark. So Chris, coming off of your recent little presentation you did at the REIA Mastery Series, when you got asked to do that, we just want to get in the mind of Chris Pomerleau here. What was it like being asked to do a public speaking engagement, which you've done several times, but
yeah, I mean,
what's the process?
I was sincerely honored. I mean, because you guys run a lot of stuff and you have a lot of people to pick to speak at these things. I don't know if I was 18th on the list or towards the top, but I was very appreciative.
It went out to our entire distribution list.
Everybody that we asked was the first ask.
Well, I was kidding.
Yeah.
No, sincerely, not just bluff. I was honored that I was asked to do that. I don't mind speaking. I speak at college campuses now. I'm starting to get called to some panels and stuff. I've been on a lot of podcasts. Look, I like talking about it, of course, but I sincerely have always grasped onto this. I want to relay the information I've learned to people quicker so they can learn quicker, because it took me sincerely just YouTube University for like years. And I was an attorney the whole time. So this is like on the drive to work and in between cases and at night. And I just want to relay that information to people and teach people, because there's so many things you can break down, limiting beliefs or whatever. Once you get past that, I was honored to do it just to share how we had done it, because I think it would resonate with a lot of people. And I think there was a good response to it.
When you're getting up there and you kind of have pregame jitters and you're getting ready to present, what's the most nerve-wracking time of being asked up until the point where you're taking the stage and talking? Is it just right before, like you're walking up?
So I wasn't nervous at all, but only because I had done it before. And actually, I think what helped me is that just the things I've done throughout life. Like I was in certain high positions in the military, so I had to speak in front of a lot of people. And then really, I think what really helped is that I was an attorney. So I got huge butterflies there because I had 2-3 day trials and I had to always speak in front of judges. And that kind of helped me weed through that. I took speech courses and stuff. I've always kind of done those things. So I was not nervous to do what we did a few weeks ago, but that's because of how much nervousness I had to go through over the last 10, 15 years of all the public speaking I've done.
It wasn't like Andy Corey that was like sweating bullets.
Yeah, crushed. He did. Yeah, you could not tell at all. He was ducking on water.
That was his first time ever speaking.
No slideshow, just riffing from a piece of paper.
Just raw dogging it.
And he crushed.
And he was so nervous too, because he's like, if I run out of time, I don't have enough time. Just let me know.
He had that fight or flight look on his face before he went up on stage.
He was pacing.
He was, but that's kind of his personality.
He killed it though.
He did a great job.
Yeah. So, Chris, what's been going on with you lately? You know, you and I, we own Liquid Lending together with a couple other partners, and we had our quarterly planning session this week. So I've gotten to see you more than I would like sometimes. But no, so that was an all-day planning session, and we recently hired this business coach, Blake Berkey, and he's been working with, about a year now? Is that about right? Yep. So we've done like 3 or 4 quarterly planning sessions. We basically kind of like went from the Stone Age in our business to implementing EOS or EOS Lite. And like, what do you think? You've been through this iteration in 3 of these planning meetings in the last week. Yeah. Is that right?
Yeah, I have.
Yeah. What do you get out of that? And do you think, I guess, is there rule of thumb maybe where if somebody's starting a small business and they're like, I got to get my shit together, at what point do you think it makes sense for them to maybe look at a business coach and putting in EOS and, those kind of things?
Yeah, I mean, I think we started doing these things when we were far enough along our career we could afford a coach like that.
Mm-hmm.
I mean, people just getting started. I think with AI now, ChatGPT, and kick me out an EOS program to run my company for beginners or people early on, I think that's something they should do.
Smart.
I'll always want that human connection, especially with how often I ask questions and I interact and stuff. But overall, I leave every one of those meetings with just so much motivation. I really do. Even the dreary, rainy day that we had, it's rare that you get everybody in the company, or at least the C-level people, if you will, into a room and visit what you've done previously. What have you accomplished over the last quarter, what the goals are for the next quarter, over the next year, the next 10 years, provide due outs. Because, especially with a thing like liquid lending, it's just like four musketeers just kind of winging it, just doing random things here and there. And things are working on Google Sheets and all these things. But when you get a business coach like Blake to come in and help you run an EOS type traction type approach, it just makes it a little more formal. And I know a couple of people on the team don't like formality. They don't like emails. They don't like being anywhere.
I don't know why the gesture was in my direction there.
Because I don't, despite the jokes amongst my peers, I don't like emails either. I wish I spent less time on emails. But I do think herding all the cats into a room to say, look, if we want to take this business to the next level, let's get a pro teaching us and let's commit to somebody like that. I leave every one of those meetings just yoked. Not like 1,000 push-up Colin yoked, but like just super excited.
Well, I actually don't like it, but I think one thing when you introduce a business coach into basically an entrepreneurial ecosystem, typically people like to start their own business, or at least one reason why is they don't want somebody's thumb on them all the time. They don't want, having a boss and somebody else being in charge of their time. But honestly, like, you still need the accountability. And that's the thing about, being a one-man show or one-woman show. It's like, you're making all the decisions and maybe you're doing things in the business, but you're not working on the most important things, like the one thing that could really move the needle. And having somebody illuminate that and kind of pull back the forest so you can see the trees. And it's, I think, super helpful. And then putting clear goals around, things that you want to accomplish in the business, as opposed to just an idea. Yeah, we'd like to be at 50 million, but then you have to break that down and say, here's the plan.
I think that one of the things that we're learning, even ourselves, but what people can learn as they run their business, is identify the things you don't want to do. If you don't want to be that formal guy running meetings, doing things that it's fun to say, I got away from corporate and therefore I don't have to answer emails and I'm my own person. But you could look at maybe, I don't know, every large company in the history of the world. and they have a formality to their business. There's winging it, and then there's some formality. And if you don't like running with the formality, you can still meet quarterly and identify someone on your team like Luke or like Mitch that can help formalize the business plans. So that's where the C-suite or the owners can step in, provide their feedback. There's some do-outs for them, but they don't have to sit down and upload everything to a project manager system like ClickUp or anything. That can be done by somebody on the team whose job it is, but just to have somebody on the team who's also being led by Blake that can kind of herd the whole group, I just think it's something everybody needs. And you don't have to start with a high-level coach like Blake. I do suggest that to somebody who can afford it, but it's something everybody should look at.
Do you guys have like a structured leader in place for like liquid lending per se? Or do you guys really all say we're the owner, which I think would be kind of hard considering most of you guys probably have a high D personality. And
yeah,
I'm guessing that's where the business coach comes in and tries to keep that balance. Or
no, that's a good question, a fair question. When you have a partnership where you've got 4 owners that are all motivated and like we all have a lot of different things going on, I don't know if gravitated is the right word for it, but it seems like we've all found our kind of lanes. Mm-hmm. So it's more of like we're in charge of new business development or we're in charge of the back office stuff. Whereas like, Brandon, you're not exactly the same, obviously, but like Brandon and Chris run more of the back office stuff and make sure the train is on the rails, where Colin and I kind of like do a lot more of the social events and drive business through new borrower connections, getting referred to people, those kind of things. And certainly you and Brandon do that as well. And Chris has definitely been the front runner in capital raising. So I think we've kind of slowly gravitated into our seats. And I think it's more we're in charge of a certain certain parts of the company, as opposed to like I'm the owner or I'm the CEO or whatever.
Well,
right?
that's where it's nice to have somebody like Blake or an outside party come in and identify that, those do outs, those here, you're doing this, you're doing this. Because when you have 4 owners like this, I mean, Colin and I struggle with this even in Leavenworth where there are 2 owners. It's like, who's doing what?
Mhm.
And let's not overlap, but let's also make sure we're bringing enough to the table. And I love how we've found our own lanes at LLS, but you still need someone high level to make sure the business is on track. And that's why you pull in somebody like Blake.
Yeah. And it's been, we've brought this up on other episodes too, but after we made the decision to hire Luke, kind of like, we were not quite a year into Luke working for us, and we've compared him to, the integrator and what's the
COO?
He's basically the integrator, whereas the visionary is somebody that has all the ideas and we're running around doing our stuff. And then we brought him into the fold, and we weren't necessarily ready for him. It's not like we were advertising for an open position. It's just like he became available and we saw the skills he had. And then after several interviews and conversations, he came on board, and it was just like, I almost feel bad now because it's like we each have stuff that we're good at or don't like to do or whatever. And we end up throwing a lot of stuff over the wall to Luke, and he's so good at catching it generally that we just, keep loading him down with things.
Maybe that's the high eye that Owen has, though, because that is Luke's job.
Yeah.
So it's cool that, and I do too, when I always feel weird kicking something, even at Leavenworth, like I feel weird kicking something over to a teammate because in my life, I just did it myself. But that's not how you build a business. And I've certainly gotten more grays, maybe because of kids too, but just once you get to a certain size, you realize, holy cow, I shouldn't be doing everything. So what's good about that is that now when I'm starting new businesses, I'm like, let's build this like from what I've learned before and what I want it to be. Let's start hiring right away so I can concentrate on important things. So Luke's been phenomenal for us.
It's also, as you get kids and you start getting older, you want to have a time with them too.
That's true.
So it's a little bit easier to hand those tasks over.
Yeah, I mean, I agree with you. There were some people on our team who were a little hesitant to hire anybody because that meant technically less money out of our pocket. But in my opinion, that's a short-sighted view, because with a lot of those things being taken by somebody high level like Luke, it allows us to go out and make it really grow, which it has.
I was shocked at the fact that last night we had Megan Ahern speaking, and both Colin and Owen were at the front pitching liquid lending.
Yeah, it was mainly Colin. I did that on purpose.
Yeah,
he kept trying to hand me the microphone.
I don't think they've ever been in the front because you guys were the event sponsor last night, and I was like, look at this! They're actually here to talk about liquid lending.
That's great.
Yeah. No, just to kind of wrap up that.
Probably got a lot of business last night because of it.
Not yet, but I was hoping my phone would wake up to a bunch of notifications. But I think that's been a fun business, and one where we kind of just slapped together in the beginning. We all had some extra money that we thought this would be a good business venture to get into, and it grew and grew and grew, and it ended up being probably one of the more profitable things we've been involved in since,
from a cash flow perspective.
Yeah.
For sure.
So it's been a lot of fun. We're going to definitely spend more time kind of like putting together some marketing stuff and so forth for liquid lending, and because we've done literally zero in almost
5 years.
Yeah, 5 years. So anyway, you're going to probably be annoyed with some more marketing messages from liquid lending, but we're excited about it. We've got some new types of loans we're kicking around doing, and we're solidifying some relationships with some other folks that are going to help us kind of level up and do some bigger deals.
Yep.
So it's exciting, Ted.
Always something going on. What do you guys buy in lately?
Chris,
a lot.
Yeah. What do you got in the hot? Like, I don't even know sometimes.
Yeah, it's great though, because I think the market, I have more deal flow now than I've had for 3 years. I think these notes that people locked in 2021, 2020
I'm one of them.
They're coming due. Yeah, sure. I have some of those too. Luckily for our business approach is that we never intended to flip anything. So we never bought something in 2022 saying, hey, market to me better in 3 years. We're just going to sell it and make a bunch of money. And that's where a lot of syndicators and real estate owners in general, flippers, that's where a lot of them are getting a little trouble, because your entire business plan is timing the market.
Mm-hmm.
And that's really tough. And I've learned this throughout the process, but some people in our space like to kind of bifurcate or butt heads with the stock market and real estate or whatever. There are so many similarities. I stand by it. Real estate's better. And for 100 reasons I could explain, I still diversify into the market. So I'm not trying to pin them against each other. But if you try to time the market, Brandon did it for 18 years or something?
Yeah.
If you try to time the market, buy the stock, sell it in 2 years, I know I'm going to make a bunch of money. That's really dangerous. You can make a lot of money or you don't. So back to what we're doing, luckily for us, we do have some loans that are going to come to maturity this year or next year at higher interest rate than we ever expected, but we always intended to hold the property anyway. So the only thing that changed a little bit was at the refinance, we're getting a little bit less money or a decent amount of money less back at the refi, but we're still holding a great asset that we're going to hold for another 5, 10, 15 years. And so it's not really affecting us. That deal flow, though, for the people who planned or their entire business plan was to be done right now, I think they're struggling. And that's why our deal flow is huge. I mean, we closed 180 units this year locally. We closed 126 units up in Sioux Falls. We have another 80 units we're going to close in the next couple of months. I think we're really close to 156 units. And that's all this year. And look, that's because of the market. That's because of the systems we built over the last 5 years, the trust we've garnered. But I am very, very surprised and thankful with how busy I've been underwriting lately because there's a lot of deals.
Now, you have gotten pretty adept at raising capital over the years. I think you told me a little while ago, you guys have, Levin Wealth has over 700 investors, outside investors.
Yep.
So you guys find the deals, you vet them, you underwrite them, you manage the asset. You make sure everything's all good to go, and then you raise money from limited partners.
Mm-hmm.
So, and you do 506c syndications typically, correct?
Correct.
Basically, you can advertise. So, there's risk to any investment and all the SEC regulations around advertising for it. But with 700 investors, how much of your time as kind of the de facto investor relations guy, unless that's changed, right? Is that still you? Or have you kind of moved that over into someone else?
So we have somebody on the team, Jason Belt, who his sole job is to raise money. He has a lot of good connections. There are many of those where he'll prime them and he'll have 1 or 2 meetings with them. And then there's that final sit down at a lunch that I'll attend. As far as the emails and setting up accounts and stuff, we have another person on our team named Megan who can help. Or at LLS, Luke and Mitch are kind of helping that. Even Megan's helped at LLS set investors up on our portals. I really like talking to investors. I didn't think I'd like that. I mean, look, there's a pro and a con though. I like it because I am high I and I'm not a salesman. So what I've been told 100% over and over again, and I kind of don't want to know this about myself because I don't want to change this, but I'm not a salesman, so I'm not pushy. I'm authentic. I'm honest. I'm saying, look, this could be, this couldn't be, but this is why we think it's good. Invest if you want, invest if you don't. But I like doing it because it's been successful. We raised a lot of money. We raised over $100 million. And also organically, which is really back to what Owen said, which is just mind blowing. Like we haven't said, outside of maybe a couple posts that I tried to figure out Instagram one day myself, like we haven't really marketed to our investors. So I think I'm really excited for what Maren and Blake are going to input for us because I think when we start telling the world what we have available, it's going to even skyrocket more.
When you have 700 investors, I couldn't imagine how much time it takes to do like into your taxes, K1s. I mean, there's a reason why you hired Mitch with no hair, so he didn't feel bad when he was losing it. Yeah.
Well, it helped with Mitch though because Mitch was already at the CPA firm Franco Zachariah, already handling most of our stuff.
He was my guy. I was so upset when he took
So he came over. He's been such a help. And it's a lot of work. It's a boatload of work getting these K1s. We have all of our K1s out by March for our syndications so that everybody doesn't have to file an extension. I can't promise that'll happen forever because we just launched a vestment fund at Levin Wealth. And the vestment fund is unique in the aspect that it's an open fund. It's what they would call an evergreen fund where you can invest any single day you want. You start earning returns that day, and you're going to own everything the fund owns. So like right now, an investor in investment, just at this very moment, owns 180 units. They own 126 units in different states, and then they have over $700,000 in LLS earning 10%. So it's like a mutual fund almost of different things. And it's a $50 million fund. We've raised $4 or $5 million. So the world's kind of our oyster as far as adding to this. And what's so good about our approach is that not only are we not timing the market, we're not saying let's flip this thing in 2 years, but also now with our investment approach, you're not timing the market, but also you're mitigating risk by spreading your investment out amongst a million different things or, 20 assets, which really helps mitigate risk too. So it's really excited our investors. I like talking to investors. And what's the 80-20 rule?
Pareto's.
Yes.
Pareto's law.
700 investors. I talk to 10 of them. Same 10. They have questions every month or every other month. I have one guy it's funny. He was upset. We paid him too early. He's like, you paid me on the 5th, and then you paid me on the 7th for a different property. I want you to pay me all on the same day for every property. Like those are the kind of, sometimes you have to spend time with these people. But when I thought I was getting out of the divorce world as an attorney, I was like, oh, good. I had to leave all that emotion. And then I realized, holy shit, I'm just managing people's money now. So there's even more emotion. So it's fine. I really enjoy what we're doing now.
Yeah. Well, okay, Chris, now you guys primarily invest in, and maybe this has changed, but 7 different states, primarily in the Midwest?
Correct.
And if you had a gun to your head right now and you had to pick one city, what would it be?
Omaha, because I'm here.
Okay.
And the only reason we left Omaha is that there weren't deals as often. That continues to be the case. Things don't trade as much as in Omaha as they do other cities. I think we were really early on in Sioux Falls, which I'm really happy about. It just so happened that we got in early, and then the whole world found out about Sioux Falls, so they've struggled with a little rental compression. But Omaha would be my number one pick. I think Sioux Falls would be my second pick. It's nice and close, 2.5, 3 hours away. Everything continues to appreciate, even though with the setbacks in the market we've had. It's hard to pick. I can tell you a couple states I don't like investing in anymore.
Yeah,
certainly,
what are they?
Certainly Texas. I mean, Texas has been hit hard. With the increased interest rates caused the increase in cap rates, which caused a drastic reduction in the value of the assets. And that is something that everybody's dealing with, whether you're in Sioux Falls, Omaha, but certainly in a place like Texas that got super saturated. I mean, this is
yeah. Was building a big factor there too, and unit absorption?
It was the worst combination of every situation that could happen. It was COVID causing a lot of people to move to Texas. They wanted to get out of California or these states who believed in science and COVID, and they wanted to leave, and they wanted to go to a different state. And so they did that. At the same time, everyone's investing into the market, and if you're getting 3% rates and the world's easy and real estate's easy, all into Texas, and then boom. And interest rates skyrocket. Everything starts hitting hard. And then Texas got hit with, the whole world's been hit with this, but because of the large amount of money going into real estate there, that meant there was more real estate to be affected by insurance claims. So insurance is affecting everybody. I mean, I had an asset in Kansas City, doubled in insurance year over year. But of course, Texas has been struggling with insurance, and then taxes in Texas. So I don't really care if I go there again. There's another thing that happened with the governor there has signed a couple bills retroactively, which is messing up a lot of people's situations. So I don't really care if I go to Texas anymore. But Omaha's been great. It's great to see your assets. Great to be able to walk them. But as long as we can drive there, then we feel pretty comfortable.
No, you're in Tulsa. Also, you have a decent footprint there, right?
We have a 64 unit in Tulsa.
Oh, that's it. Okay.
Yeah, and then we have 200 some units in Wichita, 300 some units in Manhattan, Kansas, around 80 units or so in Kansas City, 150 units, 160 units in Lincoln, 650 in Sioux Falls, 120 some in Rapid City, and then about 450 in Des Moines. I like Des Moines a lot.
What a management nightmare.
It's been tough, man. Like, it's just a learning lesson. And back to what we were talking about off camera, like, we were doing it all ourselves and then growing. And then we brought property management in-house to a company we are part owners of. We're not operators. We have oversight, but the operators are really good at what they're doing. But then now they have to learn every single new city, new market. And so it's been tough, but we've worked through most of the kinks. And it's really just, I view this as one giant mutual fund or mitigated risk approach where you're in different cities, your different asset classes. We have Class A's just built a couple of years ago. We have Class C's built in 1920. And so it's just a good way to spread around our money.
When you were bringing that property management company kind of into the mix, you're essentially almost like private equity there, right? Because you have equity stake in it, but you don't have the day-to-day oversight and decision-making involvement.
Yeah, I mean, in an operating agreement, it says who the owners are. It says what the major decisions are. We're a part of those major decisions. But when it comes to day-to-day, there's no reason to include us because not only are they better at running a property management company, they're boots on ground, they know what they're doing, they've been running a large property management company for a long time. I'm having lunch with someone who's going to invest at $1.5 million. I don't know if I should be taking phone calls about what to do with this toilet over here. And I don't mean to say that's all they deal with is toilets, but like it really is divide and conquer. And PGO and the Farha brothers and Danny and all those guys have been so great, so nimble, so great to work with. I mean, we're already thinking about bringing on third-party property management now.
Oh, really?
Yeah, because the systems are getting so good. And some of the good things are there's like we're really close to agents now, right? So MMG, Shana Patrick, shout out to Shana Patrick. She was at CBRE in Des Moines. They made a big mistake, and she's no longer with them. She was at MMG now. MMG is a great group of guys. They kind of run the Midwest agents, but they send out quarterly reports. Oak in town here sends out quarterly reports, and we get to see how the market in different cities is actually performing. And it's so nice to take that data and compare it to how our in-house property management company is doing, so we know how to compare what's going on, and they're hitting every metric. I mean, if the average in this city is 92% occupancy, we're at 92 or 93%. And then also, we've gone through the pain of having third-party property management companies where they're not good. We fire them, and then you take a step back for like 3 months trying to figure out or onload the new property management company. Whereas if you have it in-house, if something's not going right, you let one person go. Mm-hmm. You still have the other 70 members of the team who are running the show. So that really helps us take care of our assets as well.
this is what I was curious about. So let's say you're getting ready to buy a larger deal, so 100 plus units, right? So it's in maybe Sioux Falls, say. How do you do the calculus and you say, all right, and I'm sure this probably happens to you a lot. You're looking at a property, larger property like that, and it's like 30% of the units have been remodeled in the last 5 years. And then so that means there's room for you to run, right? People always pitch pro forma when you're getting ready to buy. Like I've had this happen before where I bought a building and let's say it's something smaller, like a 12 unit. And I'll be like, okay, all the units are occupied, half of them have been remodeled. It's more or less stabilized. I have value add opportunities with rent rates and, operational improvements. But then you buy it based on a pro forma that's nice and pretty. And then all of a sudden you get 5 or 6 people that all live in quote unquote classic units that put in their notice.
Yeah.
Now all of a sudden you have unit turns that are going to be 12 grand, 15 grand instead of just like a make ready on a remodeled unit already where it's $1,500. Like, have you had situations like that happen where you bought large properties and like all of a sudden you have a CapEx barrage that you weren't counting on? And how do you handle that?
I mean, look, gosh, we have 3,300 units now. So I can't say there has never been a CapEx surprise, but I can tell you, and this is a phrase commonly used for syndicators, that we underwrite conservatively. But I promise you, we underwrite conservatively. And I do that because it's great that I can go raise money for $250,000 from this guy over here. But if we're not successful in that 250, not only is he not going to invest or she going to invest in our next deal, they're not going to say anything nice to any of their friends.
Right.
So I would rather conservatively underwrite, not to get their money once, but to make sure that their expectations are managed. And then it gives us a little leniency. For example, we almost always take out a CapEx line of credit.
Okay. This is where I was going with this. Yeah. I wanted to see if that was a regular, like standard operating procedure.
It's pretty standard. So we'll go to a bank and what we'll do is we'll say, hey, look, bank, we're going to buy this asset for $6 million. If the current owners did everything we would do today, it would be worth $10 million. Not because I think this city is going to be great in 4 years, but literally today, all the comps, we already know the rents are this. If you made it this way, it would be worth $10 million. And so you take that business plan to the bank and you say, look, it's only worth 6 today. That's because they haven't done what they should do. Give us a loan, 75, 80% of the $6 million. Then give us a loan for the $2 million we need to put into the deal. And so now we're all in at $8 million, but it's worth $10 million. So we just refinance it, pull all $8 million out, and you're into it for $0. Now, sometimes you're into it for 30% or 70% what you're doing. But the reason the bank feels comfortable with that, and the reason I feel like we've mitigated our risk, is that now you have 3 people who all believe in the business plan. It's not just Chris in his basement. It is Chris in his basement underwriting with 12 years of underwriting experience, and I do trust my underwriting. But then you got to take it on to the bank. The bank's not going to lend you $8 million unless they feel very comfortable. So they're going to make sure it's worth it. And then they're going to hire a third-party appraiser. And the appraiser is going to come in and say, I'm going to do 2 appraisals. It's all on one form, but I'm going to do an appraisal. Is it worth $6 million today? And if they really put in what they're going to and they raise the rents to what other comps are in the area, will it be worth $10 million? The appraiser confirms it. So now you have the whole Leavenwell team. You have the bank, and you have a third-party, unrelated appraiser all saying this business plan is legit. And so it helps really make us feel comfortable in our approach to this.
Do you actually sit in your basement in the dark and underwrite? Because that's kind of what I've always pictured. You're just in a dark room with one lamp, kind of dark all around, and you're just underwriting on your iPad.
We had an office here in Omaha. Leavenwell shared the office with our in-house property management group at the time, Bricktown Management. It was 10,000 square feet. Well, once we joined forces with PGO and they got a new office, we had 10,000 square feet for Leavenwell, which was 10 employees, 7 of which didn't live here.
So each employee got a 3-bedroom house, basically.
Yeah. So we were like, we don't need an office. We really don't need an office. So yes, I am at home doing that. The lights are on. But yeah, I mean, I love underwriting. That's another thing that we're starting to delegate off. Now, I'll certainly put the bows on and cross T's and dot I's at the end, but that's another thing because there are so many deal flows now, like I'm not going to have time to get to them. But yeah, I'm in the basement.
When you have a portfolio that big and you got another business partner, like, do you have to put your own money in every single deal at this point? Are you raising all the capital, or are you like putting your name on the loan and that's the value you get?
Yeah.
And then in the end, is the big picture when these start paying off down the road or when they sell, like, how do you get your money out of this?
As a GP.
Yeah.
As a general partner. First question was, do we put our own money in? 100% of the time. You don't have to. I know other people in this space who have been relatively successful who don't put $1 in. They just go out and raise it all and they say, hey, let's take this ride. And that's fine if they can talk their investors into it. I personally feel it's extremely impactful if I can say, I believe in this deal. I'm going to put my money in with you. So I don't want to lose your money. But if I lose your money, I'm going to lose my own money.
Mm-hmm.
And I think that's super powerful. I also believe in real estate, and I would never want to buy something that I didn't think was successful. So I should put my own money in anyway. So we're certainly putting our own money in there. Yes, it is a huge benefit to the investor that we're signing on the debt.
Mm-hmm.
So not only are we taking the same risk with our capital that you are, we're taking a risk you don't have to take. We're signing on the debt. So sure, you put $100,000 in and the whole thing goes belly up. You may lose $100,000, but you're not going to lose the $8 million that you owe to the bank. We would lose the $8 million because we signed on the debt. That is what we should do as the general partners. You're passive as the investor. When you invest in the stock market, you're not balls deep into what Apple's doing every single day in their meetings. You're hopeful that the people who run Apple know what they're doing. And that's what we expect from our investors, to be passive. And of course, that's laid out legally in the PPMs and whatnot. So sure, we sign on the debt. That's extremely beneficial for them. And we put our money in. What I say about why it's also beneficial to invest with us is that we do something called a preferred return. Now, that's not uncommon. A lot of people do preferred returns. I have learned that people aren't. And here's the difference. A preferred return that we do is 7%. So the first 7% of profit every year must go to the investor. If it only gives 6% year one, and then the whole thing returns 8% year two, all 8% goes to the limited partner because they need to earn, on average, 7% every single year. As general partners, we made $0 right there. Now, of course, the money I put in next to you as a passive person, that made the 7%. But where I become less of an employee and more of a general partner and somebody who can make more money than others is if it performs over the 7%. That's where you start dividing things. We might get the next 3%. We might divide everything 70-30 with the investor getting 70, us getting 30. But I've told this story 100 times, and there's a couple assets. Well, this has never happened, but it could happen in the next 3 or 4 years with the interest rate situation, is that if it makes 7% every single year for 10 years, and then we sell it and the profit is 7%, we effectively just worked for free for 10 years. We did get an acquisition fee up front. And I can be honest right now, most of that goes to pay for our employees. We have very well-paid employees because they're great at what they do. But obviously, that should maybe be the fourth layer of mitigated risk for the investor. You should know, I'm going to do all this stuff, and I think it's going to perform way better than your preferred return. I'm not taking a risk with your preferred return. I'm trying to make it make 15%, 16, 18, so that I can make some money on it, and that's why it's so beneficial.
I really like that. You were one of the first people, I think I remember, specifically calling a real estate deal a business plan, or basically when you're putting together your plan for that property and how you position it to the bank. I remember you calling it that, and I remember that kind of like sticking with me, because most people that are in real estate, well, A, they don't get to the level that you guys are doing, multi-million-dollar syndications, but they think of more real estate as real estate. And I like how you package it as a business plan, and you can go to the bank or a lender or an investor and you can say, here's the story. Like, I'm going to tell you the story on why this is going to work, why the current ownership is under managing it, why the opportunity to add $4 million of value exists over the next 24 months. And here's what I'm going to do to get there. And if you can talk through that, then they're just validating what you just said with the numbers, right? Because they'll have an analyst combing through your stuff. But if you can come in with a business plan and say, here's why this is going to work, tell me where I'm wrong, and give me your money.
Well, I mean, it's called a business plan, and the reason it should be structured as such and sold as such is because you are running a business. And I don't mean to say that flippantly. Of course, Leavenworth is a business. I mean, the way that multifamily 5 units and higher are valued is as a business. It's a common misconception to say, well, that apartment's 100 units and it sold for $8 million. Why would that 100 unit be worth $10 million? Because that's a business. Mm-hmm. What's the net operating income? What are the income minus expenses? What's that figure? You could have two assets next door to each other that are both 100 units, and one could be worth $2 million more, because as a business, it's being run better. And so if you can explain that to the bank, they feel comfortable, not only that you are putting that much thought into it, but that actual business plan is really important for the appraiser. Because a lot of people say, I like real estate, buy and hold. I mean, the best phrase I ever learned was, I wish I would have bought quicker, like in my life, and I wish I would have held on more. From flippers, I hear that all the time. From apartment flippers, I hear that all the time, is because you can make money, but once you're done selling stuff, you're done making money. And that's why our business plan is so successful, in my opinion, is that sure, 2 years in, we may not be hitting the numbers we thought, especially with what happened over the last couple of years. but we're always going to hold this 15 or 20 years anyway. That was the business plan. And so it really helps solidify to the bank what we plan on doing, and we back it up with numbers. And then actually, when we go to the investor, we can articulate exactly what our plan is of why we think it'll be successful. So you're right. It's a story you need to tell, and it's how you sell yourself and the asset.
Cash isn't unlimited, and I know you're saying you're putting cash in all these deals, and tell me if I'm wrong, but pretty much, I've seen your progression over the years. You've gone from flipping houses, buying stuff in, different parts of the city, going to getting into duplexes, then getting into quads, getting into 9 units. And, but is it safe to say that process of buying, selling, started building your cash flow, and then even today you're probably selling off the lowest assets to keep that cash flow grow to bigger assets? Or how you consistently bring in enough cash to buy these huge multi-million-dollar deals?
Yeah, I mean, so you said a lot there. We are selling smaller stuff, mainly because they're harder to manage, in my opinion. You have a duplex and it goes vacant for 3 months, and you've been 50% occupied for 3 months. Like that's a huge shot at everything. Or you have one HVAC go out and the entire year's cash flow is gone. So the reason I felt comfortable getting larger and larger is that the business plan for a single family is surprisingly similar to a 100 unit. Mm-hmm. And I felt comfortable doing this because, not to backtrack on what I said before the cameras turned on, but I do wish I would have maybe gotten a coach a little earlier, and I wish I would have bought 100 units a little quicker. But because I didn't, I learned the hard way how to do the whole thing with a single family. And I mean the whole thing. I mean flooring, toilets, the whole thing. And after 4 years of doing that with single families, and then a couple duplexes and a 9 unit, I felt comfortable enough to where this all makes sense. Same business plan for 100 units, same talks with the bank, same everything, same metrics. But also because I had done that, I had garnered the respect and the trust from prospective investors. If I had said, guys, I'm an attorney and I have a master's in negotiation and I was in the military, give me $250,000, but I've never bought real estate before, that's a really hard sell. If I can look back and say, I learned all this and I've done this, it helps you raise money. The question was, where's the cash coming from? The more and more assets you have that are successful, we're earning more and more money because they're making more than 7%. Or our business plan, over 60 times, I've lost track now. I think we could calculate it, but I certainly know it's over 60 times. We have refinanced an asset and pulled 100% of our cash back out. So sometimes it's not brand new cash. We're just recycling the cash. And I tell this story all the time. I have investors invested in 8 of our deals. He's put in $450,000, but he has $2.5 million of equity because he put $450,000 into 8 deals, 50, 50, 50, whatever. And then each time it would refinance, he'd just take that 50 and put it in the next one and then put it in the next one. Of course, that was easier to do between 20 and 22 because of the interest rates. Now it's just going to take a little bit longer, but it's still the same idea. So you can own those assets. So that's where a lot of that cash is coming from too.
Yeah. So he, 6x'd his money in 5 years?
So much. And
do you promise that to all your investors?
No.
Oh,
no.
Okay.
The funny you said, though,
here's our case study.
It's a good case study. It's a story I've told a lot because it's one of our longer standing investors. But I think it's important to highlight it because whether that happens in 4 years or whether it happens in 12 years, to be able to grow it that much and still own the assets while it kicks out cash flow, this guy's making $100,000 a year on that first 450. I mean, you could look at that as a 25% return, and that's not even counting equity. Mm-hmm. So in my opinion, it's the safest way to approach real estate investing because you don't have to time anything.
Are you doing anything differently with the stuff that you already own with regard to, or that you're about to buy with the big, beautiful bill and the new tax plan that was, is that changed your kind of like, oh crap, now we got to pay attention to this, or we have to ramp up and do more cost seg studies? Like how has that affected your business?
Good question.
It hasn't changed our approach because since 2017, there's always been some form of a cost segregation giving a lot of write-offs. I think the big, beautiful bill, although not to get political, there's a lot of stuff in there that has nothing to do with real estate. It's really, you know how politicians are just kind of
pet projects.
Do you want write-offs and can we bomb Syria? Like it's the same bill. It's like what's going on here? But I think it's changed for our investors actually because a lot of our investors are like, I'm a high net worth person. I'm putting money in the stock market. I have to pay capital gains on all that stuff. There's no write-offs in the stock market. Even if I get 10%, which is that 8 to 10%, if you invest this as 1925, well, guess what? When you cash that out, you're actually going to get 5 or 6% because of taxes. So the real estate's nice because if you get that large amount of write-offs, and on average, our investors are over the last 5 years, and it's going to be even higher now that the big, beautiful bill happened, a $100,000 investor in the first year is getting like $60,000 in write-offs, and it doesn't go away. If they can't use it that year, it carries on to the next year. So the question is, has it affected your approach? It's something we've pushed always with the write-offs, but this year, as soon as that bill passed, we had a lot of people start saying, okay, I'm ready to start investing again. I want these write-offs. So that's really helped.
Yeah, interesting. Huh.
I'm excited to have Jordan Downey come talk specifically on that topic in December.
Is he December again?
Yeah. And he's like, there's going to be a lot of tax changes to discuss.
Oh, yeah. It's going to be raining money for him at that event. You should up your sponsorship.
In December, you should probably have is like Onyx or Lexus Omaha coming. I mean, because what's going to happen is people are going to say it's the end of the year. I need write-offs. I'm going to go buy a G-Wagon. You're going to put $5,000 down for 125 Ks of a G-Wagon, and you're going to get $125,000 in write-offs because of the new bill. So towards the end of the year, and this is a thing that happened before 2017 with the first bill.
None of us are tax professionals, by the way.
No, get your own opinion or YouTube it or call your CPA. But towards the end of the year, it's amazing how many car companies sell so many cars because people are like, well, I need some write-offs. And that's another thing that Downey will probably talk
That's when
about.
I bought my electric truck.
You know, it's funny. Like I'm picturing Ford or Chrysler or whatever, these car manufacturers, and they're like, all right, Carl, what's the weight now? And he's like 5,998. And they're like, all right, stick this 2-pound weight up or 3-pound weight up in there under the bumper.
100%.
Like, you know what I mean? They're like, let's use some heavier materials.
When he said go get a truck, he goes, whatever you do, not go buy the Lexus SUV or whatever, because it was right at 6,000 pounds on the nose.
Oh, you're kidding.
And the way it's written, it has to be over 6,000 pounds. Yeah. So he had a whole bunch of clients. He had multiple clients who went and bought that vehicle, but it's not 6,001, so it didn't count.
Yeah. So for those of you catching this episode, we're obviously talking about a new tax bill that was passed into law earlier this year, a couple months ago, and the effects it's going to have on the assets you buy and what it can mean for your taxes. So maybe you tune into that. For those of you active real estate investors, you're probably well aware of this already, but make sure you're not leaving bonus depreciation on the table this year because the rate went back up to 100%. So yeah,
I think a lot of people will be excited about it. We should probably get Mitch in here sometime again.
Oh, yeah.
And have a discussion with him.
Yeah, he'd be good.
Mitch is an interesting cat.
He is.
We'll put him on the list.
He'd be good to have in here for sure.
He's a good guy to have at your pool parties. They bring the fun.
Yeah, him and Emily are great.
Yeah.
All right, well, how about we get into today's Golden Nugget? All right, today's Golden Nugget. This was a good reminder for me. For those of you, I'm not an insurance pro by any means, as will become evident after I say this. I was shopping a policy yesterday and finally got feedback from a broker that was looking. I had a policy that went from like $24,000 to $36,000 on a multifamily building, and obviously that's horrible for NOI. And I'm going to sell this real soon
because of that.
Well, that's part of the reason, but also I have a rate reset or it's going to double. I have 3.5 right now. Yeah, so I got rate doubling, huge insurance increase, and so I'm like crap. I have to make sure my T12 is tight on this.
Or you could sell it. You could sell it to us, and you could be a GP, and we could figure out a way to make it still hold.
Yeah, 5 cap. So I shop this thing, right? And it takes a little bit. I finally get the paperwork back, and they're like, my policy was with State Farm, and I had $100,000 deductible, which basically means the building has to pretty much burn down or substantially catch on fire or something for me to actually be able to make that work. $100,000 deductible. Wind and hail was like 5% or something. So I'm never going to be able to do a roof claim with that policy. Yep. And, replacement value was, I don't know, 5 million or something like that. So I shopped this and I'm like, can we look at like actual cash value versus replacement? I'm like, my note on it is X. I need at least like 3 million of coverage. That's kind of like if I get an ACV. And he's like, yeah, you can do that. And so the quote came back and it was like 22 grand. And I'm like, sweet. And the deductible was like 25 grand. So way less deductible, much better rate. And I was like, all right, well, like, what do you need? And he's like, I just want to make sure you understand what actual cash value means versus replacement value. And I'm like, sure, go ahead. I'm like, I'm not an idiot. I know this. He's like, well, with actual cash value, you may have it insured for 3 million, but let's say it has a $300,000 fire claim, right? And you go in and you do the work and it costs you 300 grand. But what the insurance company will do is they'll depreciate the different building components that were damaged in the fire. So if it's a 100-year-old building and it's brick that got damaged, it may be 40% of what the replacement value was. And he goes, so on a $300,000 claim, you may be reimbursed for 150 grand. And I was like, oh yeah, that's something to be aware of. So again, consult your insurance pro about this, but just make sure you know what you're signing up for. And my situation, I'm willing to take a little bit more risk with this because the time window is a lot shorter. So I'm only going to hold this hopefully for less than another year. But if I was going to hang on to this thing in perpetuity, you got to really look at the replacement value and the risk that you're putting yourself at and how much money you're going to get out of it. If it's an ACV, you may be saving money on premium, but getting hammered when you do a claim when it really matters. So that's today's golden nugget. You ever have that, Chris, with ACV versus RCV, or are you across the board replacement or the other way?
We have 63 assets and 62 of them have replacement value.
Oh, really?
Yeah.
Okay. Yeah. So I am taking a little.
Have you had a major fire?
We have.
Yeah.
Yeah. And we got the money on that. Yeah, it was scary, but yeah, I mean, we got the money back because we had replacement value. So we got it back. But I mean, insurance to me, not to add to your golden nugget, but it's just one of those things like attorneys. It stinks to foot the bill, but it takes one instance where you needed that attorney or you need that insurance, and it pays for itself forever. So there's an easy way to cut corners and say, we don't need insurance, or I don't need an attorney. I can just use ChatGPT. I highly suggest against all that.
Mm-hmm.
You know, I've mentioned this before, but Marty's my insurance guy. And, you know, at one point he's like, hey, you got Airbnbs. He goes, you have to have special Airbnb insurance. And I'm like, are you kidding me? Double the price. And he's like, yeah, nobody knows where the fuse blocks are. They don't know, you know, how to assess an issue that comes up. And so I got talking to him. He's like, now the insurance companies, if you have even one short term in your building, will check for that on the listings. And if they find it, they'll deny your claim.
Really?
I've heard that. You should talk to Marty about this. I don't know if there's a loophole there in the sense that you could rent it to an actual individual for 12 months. And then that individual would need to then just purchase their own Airbnb insurance, but just for that one unit. It may help so that the entire complex isn't one unit. I don't know if that would work or not, but it could be one way to.
See, all mine are short terms.
Yeah.
For now, though, because I might have a buyer for that building.
Yeah.
Next week.
I hope you get it, buddy. I know that's been a big stressor for you.
Be nice to get all those off, and then I got to decide what to do next. Chris, real quick before you wrap, on Wednesday's episode, your speech at the REIA Mastery Series, what can people expect to hear about? What topics are you going to hit? Yeah. And just give us a quick little rundown.
Yeah, I went through 4 different areas. It was creative financing, which we didn't even talk about during this, but that's really important for people because you can use it to buy your first single family home, or you can use it to buy 180 units, 262 units like we have. So creative financing, negotiating tactics. I do think there's different negotiating tactics for real estates many times than there is to save somebody's life with a gun to their head. So not every real estate is a Chris Voss approach. So I would go over real estate negotiating. We go over partnerships. How to structure that. Again, more paperwork that nobody likes. I don't like it. I hated reading, believe it or not. Last 2 years of law school, I didn't even buy law books. I just studied outlines. I hate reading. But it's important to have that written in black and white because I've made that mistake. I've had partners in the past that signed on. They get a 30% of the property and they do 1% of the work. And you need to start spelling things out because not only is it going to take care of you in a situation where there's something bad, but it's also just going to set the guidelines. Guys, this is what we were doing. This is your roles and this is how you do it. So we go over creative financing, negotiating. We go over partnerships, and there's a 4th one, but I don't remember because I go hard.
We got a mystery segment out there for you.
Yeah.
Your presentation, after getting all the feedback, was the overall crowd favorite. So
that's cool to hear.
Yeah. And so I think you guys are really going to love what you hear on Wednesday's episode. And give us a 5-star review. Tell us what you think about Chris's interview. And if you want to get to know Chris or find him, what is the best social media to find you?
Oh, man. I'm aging myself here. I don't log into social media like I should, but Chris Pomerleau on Instagram, TikTok. I think I'm the Chris Pomerleau on TikTok. Chris Pomerleau Instagram.
We'll tag you on the Instagram.
You're a big LinkedIn guy, aren't you?
No, not at all.
Oh, okay.
All these things I should be if I'm doing things right. We're at that position where I didn't have a cell phone until I was 19, and I didn't have Facebook until I was 20. Like I still have never really.
I wish my kids wouldn't have a cell phone until they're 19.
No kidding, 19. Right? Bring back those days.
But any of those socials, it would not be hard to find me because the name's not that difficult. And my email, chris@levelwealth.com.
Perfect.
Awesome. Well, thank you. Come down. Appreciate it.
Thanks for having me.
And with that, Owen Dasher, we send us out.
On behalf of Aiden Bear, REIA Radio, and Ted Kosh, you've been listening to the world famous Chris Pomerleau coming up on Wednesday.
Thanks, guys.